Hello, financial enthusiasts! Welcome back to Stock Market Callus, where we reveal the secrets to financial success in building a solid foundation for a brighter future. This video will explore the exciting elements and begin discussing option strategies. These approaches can be utilized to start profitable trading with options. Our main focus here will be to offer a thorough grasp of trading individual options, which forms the foundational method. Specifically, we'll delve into the details of acquiring an option, commonly termed a long option. Following that, we'll provide insights into the procedure of selling an option, frequently called a short option. First, let's begin with discussing the concept of a long option. Two primary reasons exist for someone to purchase a call option. The initial reason is based on the anticipation that the stock's value will experience an upward trend soon. Rather than directly purchasing the stock, the rationale behind utilizing a call option is its cost effectiveness. By employing a call option, you can make a bullish prediction while spending considerably less capital than buying the stock. This cost advantage results in the potential for significantly higher returns on your invested capital as opposed to an outright purchase of the stock. Now, let's analyze real-world option prices, specifically observing call option prices for TLT. These options have a 31-day time frame until expiration. To simplify, the current stock price is approximately $122. Let's pay attention to several options and their associated prices. If we consider the mark price of these options, which represents the midpoint between the bid and ask prices, a few examples are the call option with a strike price of $121 is priced at $264. The $122 strike price call is listed at $210. Correspondingly, the call with a $123 strike price is available at $168 and so forth. Now, let's consider a hypothetical situation and then contrast the profits each option could have yielded with the profits from holding the stock. Let's assume the stock's price climbs from $122 to $130. If you purchased the stock at $122 and sold it at $130, your gain per share would amount to $8. This translates to a profit of $8 per share divided by your initial purchase price of $122, resulting in a percentage return on your investment of 6.6%. Comparatively, let's assess the potential returns offered by these call options. We'll start with the call option at the $121 strike price. This option is slightly in the money and was originally valued at $264. However, with the stock's increase to $130, this call option's value would now equal its intrinsic value, which amounts to $9 per contract. This concept was covered in detail in the Options Trading Part 3. Suppose you acquired this option at $264 and then sold it at $9. This transaction would have generated a profit of $636 per contract. Given that your initial payment was only $264, your return on capital would have been an astonishing 240.9%. Let's replicate the same process for the other call options at varying strike prices. We've outlined the calculation procedure for one strike so that we won't repeat the entire process for each. Instead, we'll present the numerical outcomes on the screen for your reference. Upon examination, it's evident that certain strike options delivered significantly higher returns than others. Notably, the $125 strike yielded over a remarkable 400% return on your investment. For instance, trading one contract could have transformed $97 into $500. Your $970 investment could have turned into $5,000 with 10 contracts. If you're a high-stakes trader and dealt with 100 contracts, your initial $9,700 investment could have burgeoned to $50,000 in a mere 31 days. This scenario underscores precisely why someone might purchase a call option instead of directly buying the underlying stock. It effectively provides leverage to attain substantial profits with minimal capital investment. This demonstration is chiefly intended to emphasize this primary rationale. The second purpose for presenting this demonstration is to discuss selecting strikes when purchasing options. The less expensive out-of-the-money options yield a higher percentage return, whereas the pricier in-the-money options offer a lower percentage return. Given their superior percentage return, this might lead you to question why we wouldn't consistently opt for the cheaper out-of-the-money options. However, there is a trade-off involved. The more distant an option is from being in the money, the lower the likelihood of generating any profit from the trade. This aspect is called the probability of profit, abbreviated as POP. Allow us to provide a more detailed explanation. Let's proceed with calculating the point at which each of these positions breaks even. The break-even point is essentially the price level at which we need the stock to recover our costs for the trade. For the stock position, the break-even point equates to the entry price, correct? If we acquired the stock at 122, we acquire the stock price to exceed 122 to realize a profit. Therefore, our break-even for the stock stands at 122. Now, let's compute the break-even point for the call option with a strike price of 121. Determining your break-even is adding the option's purchase price to its strike price. In this instance, the break-even would be our initial cost of 2.64 plus the strike price of 121, resulting in a total of 123.64. This figure becomes our break-even point. Note this formula in your records, as it assists in determining the break-even price when acquiring a call option. Furthermore, whatever the break-even price turns out to be, the stock must surpass the value at the expiration point for any profit to materialize. We are about to perform straightforward calculations for the remaining strike options. However, we will proceed by fast-forwarding and presenting the numerical outcomes directly on the screen for your observation. It's apparent that the out-of-the-money options, which yield a more substantial percentage return, exhibit a less favorable break-even point. This implies that for you even to generate a minimal profit from the trade, the stock would need to undergo a significant movement. Consequently, this scenario leads to a diminished probability of profit since such substantial stock movements are improbable. In summary, the potential for a larger payout is coupled with a diminished likelihood of profit. This is where the significance of strike selection emerges when acquiring a call option. Opting for a strike further out of the money will result in a greater potential payout due to the relatively lower option costs. However, it will also result in a notably lower probability of profit. Conversely, selecting a strike closer to the money will yield a smaller potential payout, yet it will carry a higher profit probability than the out-of-the-money options. Let's now walk you through purchasing a call option, providing a first-hand understanding of how it operates. You are now presented with a visual representation of the Facebook stock price chart. Let's assume that due to certain factors, we anticipate an impending increase in the stock price. Instead of directly buying the stock, we would acquire a call option. We are presented with options when we access the option chain. The key decisions involve determining the expiration date and the appropriate strike price for the option we wish to trade. Employing the insights gained from your previous exposure to option Greeks, let's evaluate the advantages and disadvantages of different expiration dates. For comparison, we will focus on two specific expiration dates, one set just 4 days from the present and another with a 60-day interval. A noticeable discrepancy emerges in the theta values between these two options. Specifically, options with fewer days until expiration exhibit significantly higher theta values, implying a more pronounced impact of time decay. However, it is worth highlighting that the gamma values are also substantially elevated for the shorter-term options. The heightened gamma is advantageous for option buyers as it signifies the potential for accelerated profits should circumstances align in your favor. Nevertheless, the trade-off lies in that the escalated theta translates to increased losses attributed to time decay. Consequently, there is a narrower error margin if the entry timing is not executed precisely. Considering these factors, we aim to strike a balance of opting for an expiration cycle at the midpoint. In this case, we would select an expiration date 25 days from the current date. The next step involves selecting the strike price for the option we intend to trade. It's important to recall that choosing a strike further in the money would have a higher price tag, resulting in a comparatively smaller return. Moreover, a deeper in the money option would also mean that the impact of time decay is less significant due to its greater intrinsic value and reduced extrinsic value. On the contrary, an out-of-the-money option would be more economical, promising a larger potential return. However, it's essential to recognize that this choice would come with a notably diminished probability of profit. Much like the deliberation process for choosing the expiration date, there are pros and cons associated with selecting different strike prices. In this case, let's again aim for a middle ground and purchase an at-the-money option with a strike price of $122. Executing this action on the Think or Swim platform is simple. You can right-click on the option and choose Buy Single. Subsequently, the order details will be displayed, allowing you to adjust the desired order price and the number of contracts you wish to trade. We'll assume a single contract for $262. After clicking the Confirm and Send button, you'll be presented with various trade particulars. Pay attention to the trade cost, which is $262, plus any applicable commissions your broker charges. Consequently, the total expense for this trade would amount to $263. Now, let's discuss the aspect of risk when engaging in the purchase of an option. In this context, our risk aligns with the cost of initiating the trade. The extent of potential loss is confined to the amount paid for the option, given that the option's value cannot plummet below zero. Should the option become worthless, our loss would be limited to the initial investment dedicated to securing the option. However, it's important to remember that the figures denoting maximum loss and maximum profit as presented in the order confirmation box do not encompass any associated commission expenses. Shifting the focus to the buying power effect, this term essentially serves as an alternative term for the capital requirement demanded by the trade. As indicated, the trade necessitates a capital outlay of $263. While this requirement is self-evident when purchasing options, its significance becomes even more pronounced when we delve into our subsequent selling strategy. Moving further up to the maximum profit section, you'll notice that the maximum profit is stated as infinite. This characterization is rooted in the theoretical notion that a stock's upward potential knows no bounds. Consequently, a call option is often deemed to possess boundless profit potential. However, it's imperative to acknowledge that this concept exists purely in theory. In practice, stocks do not reach infinite values. A more fitting term might be undefined, as real-world stock prices do not extend to infinity. In this context, your potential maximum profit is undefined when purchasing a call option. Turning our attention to the break-even stock price, let's delve into its implications. As presented in this trade, the break-even stock price is $124.62. This figure signifies that for the trade to achieve a break-even outcome, the stock must reach a price of $124.62 at expiration. In simpler terms, profitability emerges if the stock price exceeds this threshold, while a loss is incurred if it fails below it. This calculation involves adding the entry price of the option, $262, to the option's strike price, $122, resulting in a break-even stock price of $124.62. Earlier, we briefly touched on the correlation between the probability of profits in trade and its associated break-even point. The intriguing aspect about options is that we can precisely determine our probability of profit. Allow us to guide you through the process swiftly. First, exit the order confirmation box, right-click anywhere on order, and click Analyze Trade. The graph that appears is referred to as a risk profile. This visual tool clearly represents potential profits or losses in a trade based on different stock price scenarios. Understanding this risk profile involves grasping its axis. The x-axis represents the stock price, while the y-axis signifies the profit or loss. Focus on the blue line, disregarding the purple one for now. This blue line showcases the anticipated profit or loss based on the stock price at the expiration date. For instance, if the stock price were to be at 130, this trade would yield a profit of slightly over $500. Notice how the blue line levels out when the stock price drops below 122. This is because the long call strategy can only incur maximum loss if the stock price exceeds our strike price of 122, leaving the trade at its maximum loss of $262. Moreover, observe how the potential profits increase as the stock price escalates. Essentially, wherever the blue line rises above the zero line, it signifies profits, while below the zero line indicates a loss on the trade. The intersection point of the blue line with the zero line designates our break-even point. This leads us to the primary reason behind presenting this information, to demonstrate how to determine the probability of profit when acquiring a call option. In this example, the probability of the stock exceeding the break-even point is 34.57%. Consequently, the probability of profit is 34.57%, implying a 34.57% likelihood of this trade culminating as a winning one at expiration. Conversely, the probability of the stock remaining below the break-even point rests at 65.43%. This translates to a 65.43% chance of incurring a loss in this trade. When purchasing an option, it's worth noting that your probability of profit will never surpass 50%. Alright, let's recap the key points we've covered. A long call strategy is a bullish approach where we anticipate the underlying stock price to rise. We aim for a swift stock movement to minimize the impact of time decay, while an increase in implied volatility benefits us. In this strategy, our maximum profit is theoretically unlimited, as stock prices can rise indefinitely. Conversely, our maximum loss is limited to the option's purchase price, since an option can't dip below zero. The risk and reward scenario is neatly visualized in the top right risk profile. The break-even price, calculated by adding the entry price to the strike price, indicates the point at which we start profiting. It's important to note that opting for a further in-the-money strike enhances the probability of profit, while selecting a more distant out-of-the-money strike boosts potential percentage returns. Transitioning to the long put strategy, the concept aligns closely with the long call, but with a bearish outlook. In this scenario, we purchase a put option expecting the stock price to decline. Time decay remains a factor, and we're still looking for increased implied volatility. However, in this bearish strategy, the risk profile is reversed. As the stock price drops, profits increase, while if the stock price rises above the strike price, the entire option cost is lost. The calculation for the break-even point in the long put strategy involves subtracting the entry price from the strike price. If the stock price is below this point, you profit. Above it, you incur a loss. Regarding expiration, it's advisable to close an option position if it's in the money. Holding an in-the-money option through expiration can lead to owning the corresponding stock, which might not be the desired outcome. If owning the stock is your intention, you can choose to let the option turn into stock or sell the option and buy the stock directly, resulting in a similar outcome. However, most traders prefer closing the option before expiration to avoid the complexities of stock positions. If an option is out of the money and worthless, you need not close it. It will naturally expire without transforming into stock. So there you have it, the long call and long put strategies. By understanding and mastering these strategies, you're better equipped to navigate the world of options trading and make informed decisions that align with your investment goals. Everyone, we trust you found the video informative and engaging. If you did, kindly give the thumbs up and consider subscribing to our channel by hitting the button below. Thank you for joining us on this insightful journey into the world of Options Greek. The upcoming video, Options Trading Part 6, provides a complete guide to selling options. Moreover, don't miss out on our valuable resource, Options Trading Part 4, to significantly enhance your trading skills.